China's May exports contracted faster than expected, imports continued to decline. This indicates increasing challenges for China's economic recovery. Data released by the General Administration of Customs of the Communist Party of China on Wednesday, June 7, link, revealed that China's exports in May declined by 7.5% year-on-year, amounting to $283.5 billion. In contrast, the median forecast by Reuters economists projected a decrease of 0.4%. Furthermore, imports in May also fell by 4.5% to $217.69 billion. China's import figures have been contracting since October last year. According to Reuters, Zhi Weizhang, chief economist at Pinpoint Asset Management, stated, "Weak exports confirm that China needs to rely on domestic demand as the global economy slows down." Zhang further mentioned, in the remaining months of this year, authorities will face greater pressure to boost domestic consumption as global demand may further weaken in the second half. Data shows that China's import and export trade is even worse than during the Shanghai lockdown a year ago. This also indicates that China's economic recovery, following the lifting of COVID-19 containment measures, is rapidly losing momentum. According to a report by Nikkei Asia, Lloyd Chan, senior economist at Oxford Economics, stated after the data release, "Looking ahead, we expect China's exports to remain weak as we anticipate a recession in the U.S. economy in the second half and ongoing global destocking pressures." He added, "Disappointing economic activity data in April, retail sales, industrial production, and fixed asset investment, suggest that China's domestic demand recovery has lost momentum after the rebound caused by the reopening in the first quarter," and he further noted, "This will continue to dampen the growth of China's commodity imports." Following the data release, Asian stock markets, the Chinese yuan, and the Australian dollar all declined. Reuters pointed out that the Australian dollar is a commodity currency highly sensitive to fluctuations in Chinese demand. As economic recovery stalls, the upward trend in the Chinese stock market has faded, and small investors have turned to bearish stocks, shifting their investments to safer assets. China's semiconductor imports have declined by 15.3%, indicating a weak export market for consumer electronics products. Raw material demand has also weakened across the board, with coal imports retreating from the 15-month high set in March due to sluggish demand from the electricity and steel industries. Copper imports in May decreased by 4.6% compared to a year ago. Last week, the official Purchasing Managers' Index, PMI, released by the Communist Party of China indicated that manufacturing activity in May contracted at a higher rate than expected. Sub-indexes of the PMI also revealed that factory output shifted from expansion to contraction, and the New Orders Index, including new export orders, declined for the second consecutive month. The sluggishness in manufacturing activity and domestic investment continues to weigh on growth, prompting economists from Nomura Group and Barclays Bank to revise down their economic growth forecasts for China. The Chinese authorities have set a growth target of around 5% for 2023, slightly higher than the 3% in 2022.